Hey guys, Mike Frontera here, back with another retirement theory video. So, you've got some money set aside and you're trying to figure out what's a better move for your retirement. Invest it in your portfolio or buy yourself a rental property? It's a tough question. Thankfully, I'm here to help you through it. So each has its own strengths and weaknesses, and ultimately it's got to be the decision that's best for you. So I'm going to walk you through the 6 main attributes to consider when making this decision. Let's do a boxing theme. Hopefully I can find myself a good graphic to use. Round 1, cost of entry. This is always an important piece to keep in mind, and one that I commonly see underestimated on the rental real estate side. This one is a huge win for the investment portfolio because the barrier for entry is almost zero. You can open an investment account and start investing for less than $50. And if you want to add $10 a month to your investment, have at it. A rental property, on the other hand, typically needs a big down payment. Most lenders like to see at least 20 to 25% down, plus another 2 to 5% in closing costs. You have your escrow prepaid, you have inspections, and all this stuff is just to get you a key to the door. Depending on the property, and especially if it's one that you want to make a good return on, it'll probably need some freshening up. Repairs, paint, flooring, appliances. Hopefully not the biggies like a roof or an HVAC system. Either way, you need to be prepared with at least another $10,000 to $30,000 to get it ready to rent. And once that's done, you'll still want to have money left over for extra mortgage payments, upkeep, repairs. All in all, for a basic property, you're easily looking at another $25,000 to $50,000 set aside after your down payment. Again, this is an easy win for the investment portfolio. And while rental properties are great wealth builders, they tend to be better for people who already have some wealth to build upon. That brings us to round 2, leverage. As I just said, rental properties can be great wealth builders. They have an enormous advantage over investment portfolios in that they routinely use leverage to multiply their returns. The average nominal returns on a residential real estate property aren't super impressive. The Case-Shiller Home Price Index has averaged a little bit more than 4% a year over the past 100 years. But with only 25% down to control 100% of an asset, that 4% return jumps up to 16%. And that's before we even look at any rental income. Okay, let's take a moment and go through a hypothetical example with our pals Jerry and Ginny. They've got a fistful of cash standing by and they want to get it to work. Okay, so here they are. They put $200,000 down on an $800,000 fourplex. And for the moment, let's go pie in the sky and assume that the property is perfectly turnkey and ready to rent. We'll keep it simple too and forget the closing costs. And by the way, as you could probably tell, this is a hypothetical example. I'm giving up some precision in these numbers because I'm just trying to highlight the conceptual advantage of the leverage. Okay, the property, we've got an $800,000 purchase price, a $200,000 down payment. So we're taking out a mortgage of $600,000 at 6%. It's a 30-year fixed mortgage with a monthly mortgage payment of $3,597 and an annual mortgage payment of $43,165. Their rental income, we're going to say that they've got gross rents, reasonable rent of $1,400 per month. So that would be $5,600 a month or $67,200 annually. We hold back a vacancy reserve of about 8% a year, which is fairly standard, and we get an effective gross income of $5,152 a month or $61,824 for the year. Now we have our operating expenses. Again, these are just trying to be reasonable numbers. Property taxes of $9,600, insurance of $3,600, a repairs and maintenance budget of roughly 5% of the rents each year, so that's another $3,360. So we have total operating expenses of $16,560. So putting it together, we have an effective gross income of $61,824 minus the operating expenses of $15,650 gives us a net operating income of $45,264. We take the mortgage payments that we've made off of that, which is $43,165, and we're left with a relatively modest net annual cash flow of $2,099. So let's summarize this. We have the four components of returns. We have the cash flow, the $2,099, which is the rent minus all expenses minus the mortgage payments. We have the assumed depreciation on the property of 4%, so that's $32,000. Again, that $32,000 on your $200,000 investment is a 16% return. The mortgage principal gets paid down by $7,200 roughly. So we are left with a total return on our $200,000 of $41,299, which is just over 20%. Now, a return of over 20% really is not that bad for an asset that has lower volatility than most investment portfolios. The fact that you have that 25% of your money controlling 100% of an asset is a huge leg up. Now, to be fair, leverage does cut both ways. If the real estate market goes cold and prices go down by 10%, that's a 40% hit to your equity. And here's something that most people don't think about. We know that real estate is illiquid, but that illiquidity is the very thing that can protect investors from their own worst behaviors. Unlike your investment portfolio, there is no ticker symbol on your real estate property. And you don't log into your Fidelity account and see the value of it dropping in real time. That decrease is not in your face all the time. You also can't make a panicked call to your financial advisor and say, sell everything now at the worst possible time, which of course is what millions of investors do in their portfolios every time the market has a correction. So assuming it's a systemic real estate market downturn, rent checks are still coming in, mortgages still getting paid down, and most investors are happy to just wait until a better time to sell. So when real estate markets are doing well, or even when they're down systemically, this is still a major win for the rental real estate property. But what if it's just your place whose value is going down? So with that, round 3, concentration risk. You're watching this video, so you are probably well aware of the concept of diversification. Not putting all your eggs in one basket. One of the benefits, as I like to say, is that diversification uncouples your financial future from any single point of failure. When we build out an investment portfolio, we are buying tiny little pieces of thousands of companies across dozens of industries in so many different countries. And if one of those companies goes belly up, you probably don't even notice. It's generally much less than 1% of your portfolio. Going on the total opposite end of the spectrum, when you buy a rental property, you are making a super concentrated bet on something that, in perhaps a extreme way of looking, is one of a kind. Meaning, no one else owns that exact building on that street, in that neighborhood, and in that zip code. And so buying a rental property means that you have to make a bet not only on the future of that building, but of the location as well. What if the big employer in town has major layoffs or relocates, or a highway gets rerouted right past your street? Maybe a big concrete plant gets approval to build down the road, or a hurricane comes through and damages your property but also devastates the town. None of these are rare events. And when it happens to your place, it happens 100% to you. For that reason, round 3 goes right back to the investment portfolio. Oof, that was stressful. Well, speaking of stressful, let's go on to round 4, work and hassle. I hear all the time, I love rental real estate because all the passive income. And I totally agree that rental real estate can provide healthy income, but I disagree that it is passive. Let me walk you through a realistic experience with a 4-unit building. And this is not like some horror story. This is real stuff that happens to landlords all the time. I hear it from my clients. It's January. Your tenant in Unit 3 calls you at 11 p.m. The heat's out. In most states, you are legally required to rectify the situation within 24 hours. So that means you're calling HVAC emergency services at premium rates, whether you feel like it or not. Not a relaxing way to end the day. So mid-March comes, and you realize you still haven't gotten your rent from the tenant in Unit 2. Lots of back and forth stories about how they just need a couple more weeks to get the money together, and eventually you find out the money's not coming. And you have to start the eviction process. You're, of course, still covering the mortgage, and you can't get a new renter in because the non-paying tenant is still there. And when they finally do get out, they're not happy about it. You get into the unit and you find holes in the wall and carpets destroyed and things that I've heard from clients that I can't repeat on this video. In July, the upstairs tenant's toilet overflows in Unit 4. Water damage to the floor, subfloor, and the unit below. Insurance probably covers it after the adjuster visits and the remediation crew and calls from the two tenants every day wondering what the status is. It's handled, but it's work. Meanwhile, your portfolio just sits there quietly. You can log in and check your balance in the morning when you have your coffee. I suppose if you're not careful, you could get a paper cut on one of the monthly statements, but by and large, it's an easier ownership experience. And even getting money in and out is a snap once you've linked your bank account to your investment portfolio. And that brings us to round number 5, liquidity. Okay, this one's going to be short and sweet. It's pretty much a no-brainer that an investment portfolio is going to be more liquid than a piece of rental real estate property. Most publicly traded investments, you can sell on one day and the trade's settled the next day and you can send the money right out to your bank account. Medical bill, family emergency, a surprise repair on your rental property, money's right there. With real estate, outside of your rental income, money's tied up. Getting to that equity means either selling the property, not a quick process, or borrowing cash, also not fast and not cheap. Now, if you're liquid in other areas, this is not necessarily a big deal. But, and particularly if having a rental property is a financial stretch for you, this could be significant. Okay, it looks like it's 4 rounds to the investment portfolio and 1 round to the rental real estate property. But the real estate's coming in strong for round number 6, taxes. Okay, first, there's no way that I'm going to cover all the tax benefits by owning rental property, but suffice to say, the government loves property owners. First is the depreciation deduction. The IRS lets you depreciate a building over 27 and a half years. Even if the building is appreciating in value, you get to write off its depreciation every year for over 27 years. Going back to Jerry and Ginny's place, let's say the building itself was worth $640,000. The rest was land, which can't be depreciated. Take that $640,000 and divide it by 27 and a half, and you get over $23,000. In a 24% tax bracket, that's over $5,500 back in Jerry and Ginny's pocket. Now, it's not exactly that cut and dry. It is an area of complexity, and there's income phase-outs for taking passive losses, and there's depreciation recapture upon sale. But it is a real deduction that can absolutely impact your bottom line. Plus, when you do sell, there's a common workaround to avoid the capital gains and depreciation recapture, which is called a 1031 exchange. That's where you sell your old property and immediately replace it with a new one and defer those capital gains and depreciation recapture until you sell that next property. And you can rinse and repeat that move for your 3rd, 4th, 5th, basically indefinitely. And if you ultimately leave that last property to your heirs, they can receive that property with a step up in cost basis and not pay a dime in taxes for all of that appreciation over all of those years. All the while, you got a depreciation deduction for an expense that you didn't even incur. Oh yeah, expenses. You get to write off those too. Taxes, mortgage interest, insurance, repairs, property management fees, and more. All going against the rental income that's coming in. In fact, it is very possible to have a cash flow positive property while still taking a tax loss on paper. Now, I specialize in portfolio distribution plans that are tax efficient, and I can't come up with anything as clever as what's available for rental property owners. So this round goes firmly in the rental real estate column. So now it's time for a decision. 4 rounds to the investment portfolio with 2 rounds to the rental real estate property. But those 2 rounds were biggies. So what to do? The truth is, as you could see, both have their pros and cons. One conclusion is that people almost always start with an investment portfolio and then consider a rental real estate property as their wealth builds. That liquidity is needed before diving into the rental real estate world where unknowns are around every corner. But if you have lots of liquidity and the intestinal fortitude to deal with the hassles and the unique risks that come with being a landlord, it is very hard to argue with the wealth building potential of rental real estate. So, do you have questions for me? Come visit me at www.retirementtheory.com or send me an email at mike@retirementtheory.com. Once again, thanks for joining me. We'll see you next time.